Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to New York and talk with Nick Verbitsk. He's the director of a new film called Confidence Game, a documentary that examines the final week in the life of investment bank Bear Stearns. Let's take a look at a clip.
As Bear was shoving billions in dubious loans through its CDO pipeline, management worked hard to cover up any problems along the way. Something Van Leeuwen found out when it was discovered that the firm had illegally sold investors millions in securities holding loans originated in West Virginia.
Sometimes corners were cut. According to West Virginia code, you have to be licensed by the state in order to service loans secured by property in West Virginia. It was discovered that Bear Stearns had been buying West Virginia loans for several years now, and were not allowed to service it.
Without reporting the oversight to regulators, Bear enforced a mafia-style code of silence within its walls to quietly fix the problem.
Okay, that was Confidence Game, directed by Nick Verbitsk. Nick, welcome to the Keiser Report.
Hi, thanks for having me, Max.
All right, Nick, before we get into the substance here, tell us a little bit about Bear Stearns. What sort of bank were they? How did they fit into the Wall Street matrix? And when and how did they collapse, just on a timeline?
Well, that's a good question. Bear Stearns was known for many years as the most brass-balled profit powerhouse on Wall Street, and they had a reputation that they really reveled in, which was that they did business with whomever and however they pleased. And for many years it worked to their great advantage as the profits kept piling up. But what eventually happened was fully half of their firm became sunk into the subprime mortgage business. And once we saw a hiccup in that business in '07 when Ralph Cioffi's hedge funds blew up, it was about 9 months later where the firm completely collapsed under its own weight. A lot of people say it collapsed in the space of a week, but when you really look at this story, the demise of this firm was many years in the making. When the firm collapsed, it had $400 billion in assets and only $12 billion in tangible equity. So really what the firm was doing was they were funding their daily operations in the overnight commercial paper market, and what eventually happened was when that dried up, they were refinancing a mortgage on their business just about every day, and when that source of funding dried up, the firm collapsed.
Okay, now the week that Bear Stearns collapsed, I recall that the company was effectively being attacked by naked short sales. These were far more shares being shorted than shares existed for the company. In other words, counterfeiting of shares sold to drive the price down of the stock. Do you have more information on this, and what role did CNBC play in driving this vicious loop of counterfeiting lies on CNBC while counterfeiting stock to sell the company shares down to zero?
Well, there's certainly a lot of talk about naked short selling and how it affected Bear, but really, first of all, we don't have any information on that at this point. The SEC launched a very wide-ranging investigation. When the firm first collapsed, the street was rife with rumors about all sorts of conspiracy theories where hedge funds had colluded to bring the stock down and bring the company down. But really what you started to see was, more than naked short selling, what you saw was an incredible expansion in credit default swap spreads. People were buying insurance on Bear Stearns debt that they didn't actually own. And once that happened, the incredible demand for insurance on Bear Stearns debt widened their credit default swaps and really dried up their sources of funding. Once the overnight lenders and everybody else started to see these things, they all stepped back from the firm and said, well, we don't know how this ends, but, we want to get out of this before, we're entangled in it. So it really, I think that the credit default swap part of the equation is a much bigger story than maybe naked short selling, although naked short selling, I'm sure, had an impact. As far as CNBC goes, especially with regard to credit default swaps, there was a seminal interview between David Faber and Alan Schwartz, then the newly minted CEO of Bear Stearns, on Wednesday, March 12th. And really, the ostensible purpose of that interview was for Schwartz to calm the fears growing around the firm. And before he even had a chance to do that, David Faber threw a question at him based on a credit default position that was looking to be closed out by an investor who later turned out to be Kyle Bass. And apparently Bass told Faber that he couldn't close it out with Goldman Sachs. And once Faber it kind of mentioned that on the air, everybody on the street started running for the doors immediately. And there was really nothing that Alan Schwartz could have done about that. The really troubling thing about something like that is that that trade actually cleared the very next morning. There was a point where CNBC kind of stepped over the line from reporting the news to actually making the news, and it really had a material effect on Bear Stearns.
All right, well, a couple of interesting points there. The CDS market, or the credit default swap market, it was really borne out by this particular situation, the risks involved there, when the counterparties involved in that market don't have the wherewithal to cover those bets. Famously, when AIG collapsed, they were the counterparty for many of the CDS contracts, and the traders on Wall Street know this and write contracts knowing that they'll never have to make good on them because the counterparty's bankrupt. So that's part of the fraud that we see. As far as naked short selling goes, I can tell you personally, having looked at the situation myself and knowing, having invented a lot of the technologies that run these systems, that there was massive naked short selling. It's not a conspiracy theory. It's an absolute stone-cold fact. And it's counterfeiting on a wide scale, and it's pervasive on Wall Street and throughout the U.S. economy. But let's move on. Bear Stearns CEO Jimmy Kane, who was seen golfing while Bear Stearns collapsed. Was it just because, what was that all about? Jimmy Kane, he's very famous on Wall Street for some of his peculiar habits, but what was the story there?
Well, Jimmy Kane was the longtime CEO of Bear Stearns, and since the company had gone public in the early 90s, he had become really a legend on Wall Street. He held over $1 billion worth of the firm's stock, and by far he was the most heavily invested in his own company. He was really kind of what Brian Burrow in the film calls the last of the Wall Street Buccaneers. He was really an old school guy, and I think that's one of the issues that kind of came back to bite the firm at the end, was that Jimmy wasn't really down and dirty with the business. When Ralph Cioffi's hedge funds collapsed in the summer of '07, he was reported to be in a page one article in the Wall Street Journal on November 1st of that year. It was reported that he was actually playing in a bridge tournament in Nashville, Tennessee, just as these funds were collapsing. And there were rumors that he was a big pot smoker, and he was out playing golf, Thursday through Sunday all summer long, while the fires were kind of burning around the firm and these hedge funds. So, it really became apparent by the fall of '07, about 5 months before the firm collapsed, that, he really wasn't down and dirty with the business. And beyond that, the subprime mortgage business, he really didn't have a good clue about what was happening in that business. And it later came out that really nobody did. The management style at Bear Stearns was very siloed. So different parts of the company really didn't have a clue what other parts of the company were doing. And, at the end, everybody kind of thought the guys at the top had some sort of bird's eye view. But in fact, they didn't. But beyond that, the firm was effectively mortgaging itself and refinancing that mortgage every day for many years in the commercial paper market, and the reason they did that was because it was a lot cheaper to do than taking on long-term debt. So there were a lot of things that were done to maximize profits, for the executives at the firm, and certainly Jimmy Kane led that. And at the end, it ultimately doomed them.
How much did J.P. Morgan pick up Bear Stearns for? What was that deal ultimately consummated at?
Well, it was ultimately consummated at about $10 a share. What originally had come out, and the number everybody remembers, is that on that Monday, March 17th, St. Patrick's Day, the public learned that the company was going to be sold for $2 per share. And what happened after that was that which effectively meant that J.P. Morgan was going to buy this firm for barely more money than the firm's headquarters building on Madison Avenue was worth. What happened was that there was a shareholder revolt, and at one point Jimmy Kane was exploring the possibility of actually blowing up the firm and taking it into bankruptcy, and just effectively said, I'm going to take everybody down with me. So after that revolt, it was clear to Jamie Dimon and everybody at J.P. Morgan that there was something that was going to happen. There were some contractual problems as well that left J.P. Morgan exposed. So at the end of the day, the firm was picked up for $10 a share, and they got that deal done in May, a couple of months later. So by any comparison, it is one of the great steals of a buy on Wall Street, probably in history.
Right, and then of course J.P. Morgan, after acquiring those assets for less than pennies on the dollar, they turned around and got multi-hundred-billion-dollar bailouts from the American taxpayer. So fantastic for Jamie Dimon. Again, another legendary scamster. Clarify some of the points here. Going back to 1999 and the long-term capital management scandal, when that hedge fund collapsed and Wall Street came together to bail it out with this huge multi-billion-dollar bailout, one firm did not participate, and there was a stigma attached to that firm. Was that Bear Stearns or Lehman? It
was actually both. Lehman only, every firm on the street was told by the president of the New York Fed that they all had to kick in $300 million per to bail out long-term capital management. What ultimately happened was that Lehman only kicked in $100 million, and Bear pretty much told the Fed to take a hike. Jimmy Kane basically saw Bear Stearns as really a vendor to long-term capital. They cleared all of long-term capital's trades, and he didn't see why he needed to kick in money to save this firm. And in fact, of course, he didn't. And that's really when long-term capital collapsed in '98. That was really when the term too big to fail was coined. And it certainly set up a huge moral hazard problem for Wall Street that we saw rear its head again in '08 on a massive scale. And so, there are certainly a lot of parallels between what happened in 2008 and what happened on a much smaller scale in 1998 with long-term capital management.
All right, so let's talk about what's happening now with the criminal proceedings and lawsuits that have been launched against Bear Stearns, J.P. Morgan, since the collapse. Terry Boole, who we follow on this show, she's been a guest on Keiser Report. You've worked on details that are leading to a lawsuit. Can you give us some details and updates on that?
I worked with after Terry, who's just been a huge fan of the film since day one and done a lot of really great reporting on this subject surrounding Bear Stearns and these other banks. After she wrote an initial article in The Atlantic, I was contacted by a law firm who's bringing an action on behalf of some of the monoline insurers. The biggest thing that's just come out is the FHFA's lawsuit, civil suit, which was released this past Friday, which details actually individual defendants at Bear Stearns, all of whom were running their mortgage operations and are now in very high-paying jobs at other firms. Tom Morano at Ally Bank, Jeffrey Verschleiser at Goldman Sachs. These guys have landed in big jobs at other places. So, and although this is a civil suit, not a criminal proceeding, the word I hear is that based on the outcome of these proceedings, some indictments are being bandied about and talked about. So, I think that after, certainly the Justice Department lost the case against Ralph Cioffi and his co-manager of the hedge funds at Bear Stearns, where they were acquitted on 9 counts. I think they've really been going to school on how exactly to prosecute these people for the malfeasance that they participated in. And I'm hopeful that some of these people pay for what they did, because certainly email documentation as well as eyewitness information. Apparently more than 30 whistleblowers have come out in some of these suits to describe the incredible level of fraud and malfeasance that was going on, both on the factory floor at Bear's mortgage operation, that really went all the way to the top.
All right, we're going to have to leave it there. Nick Verbitsk, thanks so much for being on the Keiser Report.
Thanks for having me, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Nick Verbitsk. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.